Hello everyone, this is Tom Fox and I would like to welcome you to episode 85 of the FCPA Compliance and Ethics Report. Today I'm really pleased to have Henry Mixon, Principal of Mixon Consulting, on with me, and Henry and I are going to start a multi-part episode on internal controls. This is episode 1 and it will be part 1 of a two-part episode on what are the basics of internal controls, how do they relate to an anti-corruption and anti-bribery compliance program, and what does the SEC and DOJ say about them. I hope you enjoy the series.
I'd like to welcome you to this episode of the FCPA Compliance and Ethics Report. Today it is my distinct pleasure to have with me my good friend and colleague Henry Mixon, and Henry and I are going to start a series on internal controls. Henry, welcome to the FCPA Compliance and Ethics Report.
Well, thanks, Tom. Appreciate you inviting me to participate. It's a pleasure to be here.
Henry is a retired audit partner from Ernst & Young. He's also been in internal audit in the corporate world. He has worked as a private professional doing internal audits and investigations. We have worked together in my last corporate position. Henry's firm helped us out on part of our FCPA compliance program while we were under a deferred prosecution agreement. And Henry has also served our country in the U.S. Army, and I think he retired as a captain. Is that right, Henry?
Right.
I don't think I've ever done this publicly before, but thank you for your service.
You're welcome.
So a very well-rounded individual, and Henry and I work together from time to time. He brings an internal audit background, accounting background, but more specifically a focus and understanding of internal controls that I don't think many compliance practitioners know quite as well. So we're going to start a series, just sort of see where it goes on internal controls. At this point, it's designed to be a 4 or 5 part, but it may be a longer series. And in this first part 1, I'm gonna ask Henry to really explain what internal controls are, and once again focusing on from the internal audit and CPA accounting perspective, not a chief compliance officer / lawyer perspective. So Henry, with that very long-winded introduction, I'd like to thank you again. I'm very excited to start this series. I know I'm going to learn a lot, and I'm sure our listeners will learn a lot as well. And if I could maybe just kind of ask you to start at the beginning with telling us generally what are internal controls, what are some of the textbook definitions, and how do they relate to an anti-corruption, anti-bribery compliance program?
Okay, thank you, Tom. Well, let's just jump right in. I think the classic textbook definition of internal controls, which is very, very similar to what FCPA guidance also includes, has 6 very related elements, and I'll go through those elements and we'll talk about them a little bit. But the 2 overriding concepts that seem to cause the most difficulty is that many people believe that the concept of internal controls is just something that applies to accountants and auditors, and they don't really get the understanding that internal controls are entity-wide processes. They're operational, they're financial, they cover the full company. There are no guarantees in internal controls because the second overriding concept is they are designed to provide reasonable assurance of compliance, because absolute compliance is way too expensive, or absolute assurance. So the 6 elements, just in high-level fashion, one is that these are measures which are instituted by an organization to conduct its business in an orderly and efficient manner, to safeguard its assets and resources, to deter and detect errors, fraud, and theft, to ensure accuracy and completeness of its accounting data, and to produce reliable and timely financial and management information, and to ensure adherence to its policies and plans. Now, how does all that apply to a compliance professional? Well, the first point would be that if you look at the internal control provisions and the books and record provisions of the FCPA, they specifically address that controls are needed to safeguard assets and resources, to deter fraud, of which corruption is just a subset, to ensure accuracy and completeness of accounting data, which ultimately results in reliable financial reporting. So the whole concept of internal controls is that companies need to focus on where their risks are, whether they be compliance or any other risk, and they need to allocate their limited resources to putting controls in place that address those risks. And in the compliance world, of course, your two big risks are assets or resources of a company, not just cash, but inventory, fixed assets, whatever, being used to pay a bribe. And then the second big element would be diversion of company assets, such as unauthorized sales discounts or receivables write-offs, which are used to pay a bribe. So that's the high-level view of internal controls, and I think the difficulty, if you embrace those concepts as being worthwhile, and certainly I would hope every listener would, how do you decide what controls you need? That's where it starts to get to be a little bit of a difficulty. The recent enforcement actions have kind of defined some common areas of control needs, like in dealing with third parties, gifts, entertainment, charitable deductions or donations, that sort of thing. But the thing to keep in mind is each company is different, and while in some companies one of these elements may carry more weight than another, a company needs to focus on what at the transaction level provides risk where we need a control. It's not just the top-side policies. You can see in recent enforcement actions where top-side policies were acknowledged to be in place, but down in the weeds where the transactions were occurring, there were no controls. And that, becomes the hard part. The second point in deciding what controls you need is to focus on preventive controls. The most common, for lack of a better term, I say default kind of controls are detect controls. That's internal audit. That's your normal audit process. Look at historical data and see if the paper looks okay, and if it looks like everything is okay, then you haven't detected any problems. It's sometimes a little more difficult to develop a control that's preventive in nature. And as this series develops, we'll get into some specifics about what preventive controls can be put in place generally without much more resource allocation than the current detect controls that are in place.
Henry, I think that's a really important point because the FCPA guidance speaks specifically to what an effective anti-corruption compliance program is designed to do, and that is prevent, detect, and remediate any issue that arises. And I think, as you have said, most compliance practitioners are pretty comfortable with the role of internal audit and the role of controls specifically in the detect prong, but they may not fully understand how you can move that to preventative and perhaps even a more proactive type of control that would move it to a prescriptive realm to really help a company stop conduct or an issue from becoming a full-blown FCPA violation. So that's certainly something that I think we could really talk about throughout this series. The other thing I heard you say is really companies need to do more than think about. They need to assess their own risk, and that's a message that's consistent for an FCPA compliance program. But how does that work in internal controls, if differently from an FCPA compliance risk assessment?
Well, the compliance risk assessment typically involves things like what countries do you do business in, how extensively do you deal with agents, do you have written agreement with agents, that sort of thing. From an internal control standpoint, you have to actually dig deeper than that and say, okay, we deal with agents. That gives us a risk. But more specifically, how do we deal with agents? For example, are all of our international sales done through third-party agents in high-risk countries, and how do we pay those agents? What do we reimburse those agents for? What do we need to know about those agents? Another example would be at the internal control level, it's important to know what are the controls over wiring of funds into foreign countries. Most companies have some controls over wire transfers, but an additional risk is presented, for example, if the country manager in country X asks for $150,000 of cash with no valid business purpose being described to that, can that money be transferred? And obviously in some of the enforcement cases we see instances where that has happened. Even though companies have the policies at the highest level, what they're not looking at is, can a person in this company, for example, get access to inventory such as laptops and give them away as bribes? And moving back into the preventive, maybe one little example of how a detective control can lead to a preventive control. Let's just say you do an internal audit, and you as compliance officer have asked the internal audit department to determine whether all agent commission payments were valid and properly approved and complied with the law. So the auditors go out and look at 50 or 100 payments, and they don't find any problems, and they look at those based upon a sample. Well, it would be very easy to conclude the company, therefore, has effective controls to make sure commission payments are accurate. However, the preventive control that's needed is to make sure no vendor can get in the vendor master file and thereby be paid unless that vendor has been properly vetted and there's a valid contract that defines how much money the vendor is supposed to be paid. So the preventive control in the future is to make sure no inappropriate vendors get into the payment system. The fact that in history you didn't have a violation may simply mean you were lucky.
Henry, that's a great example, and it brings home a larger point that I've certainly heard you touch upon over the past several years, and we've been working together, which is internal controls, anti-corruption internal controls are a subset of a larger financial internal controls. And many compliance practitioners, I don't think, fully understand how what we do in the anti-corruption space really is another type of or another example of a financial control that a company would have in place, and we specifically wouldn't think about the vendor master file as an important component of an anti-corruption internal control.
Well, and that's the whole issue with the compliance controls. Many companies, I would say probably even most companies, defaulted to the fact that our existing internal controls are just fine. All we need is some more compliance policies. The fact of the matter is that, many companies, or most companies, do not have the controls in place over assets and resources that they really should have just from a general good business practices standpoint, much less things to prevent those assets and resources from being used to pay bribes. For example, in the HP matter, laptops were given away as bribes. Well, a company that has electronic devices in inventory should have controls over those the asset movements that would prevent that. But you will typically never find that control referred to in any internal or external audit. Just like a construction company should have controls over its movable equipment so they can't be used to pay bribes. I've worked with a lot of large construction companies, and they don't have those controls. Yet they still get good reports from their internal audit. They get clean opinions from their independent audit. So there are quite simply elements of a company's business that lead to risk that are unique to the compliance world.
And I guess I would also add, but they make good business sense as well.
Well, that's the key point here is when we talk about compliance controls, we're really not talking about anything that is extraordinary outside of what would prevent frauds from occurring otherwise. For example, if you put in controls that prevent a country manager from getting $150,000 in cash to pay a bribe, you're also putting in controls that keep a country manager from embezzling $150,000 for personal benefit.
Right.
Now, it's pretty well known that fraud occurs in companies. And so when we're talking about compliance controls, we're not talking about that they are extraordinary controls. We're just talking about they have not really been focused on. And if you focus on them, once you identify them, it's pretty hard to argue that from a common business good practices sense, you don't need them. It's kind of like what your old golf coach always said, you can't hit what you can't see. Once you put it on the table and you just say, why would we not want to have better controls over wire transfers, or why would we not want to have better controls over inventory? Kind of hard to argue with it.
Right. Let me change the focus just a little bit. Most of the folks I work with, and certainly a large portion of the listeners to this podcast, are compliance officers who are lawyers, or compliance practitioners who are lawyers, or our chief compliance officers who came out of the company's legal function. How would you respond to the question of how would they be expected to deal with internal controls?
Well, I understand that internal controls are not part of the normal educational subset of attorneys, but when you think about it from a compliance success perspective, it comes down to pretty much common sense, which I think if you apply it this way, if a compliance officer who follows enforcement actions clearly knows where there have been control failures, if that compliance officer just goes to a CFO of the company and say, look, these companies got in trouble with these events. These bribes were paid because people were able to do so-and-so. If somebody in this company wanted to do that, could they do it? And then typically, in my experience, compliance officers will find that CFOs, first of all, do not follow FCPA enforcement actions. They're not paying attention to internal control enforcement actions because it's not really part of their normal job. So once you put the issue on the table and the two corporate officers start addressing the issue, it's pretty easy to move into, well, what is our risk? In our company, we don't want to pay bribes, so what is our risk? Because what I've found is that in companies that do a risk assessment, typically it's operation and financial risk, project risk, the risk that our assets will be nationalized, those kind of risks. And if the compliance officer can just start a common sense dialogue with the CFO about the transaction risk of FCPA related issues, then the CFO and his staff can propose some controls, and that's where I don't think any lawyer will have difficulty challenging whether a proposed control makes sense. Just from a common sense standpoint, do we need it or don't we? The real issue then comes is, how can we do it? How can we add that layer of resource allocation?
Well, and one of the things that I'm certainly guilty of is whenever I hear the term COSO, my eyes generally roll inside my head because I don't fully appreciate what that is and how that can be used as a framework, not only to institute controls, but actually to educate. So maybe you could spend some time explaining to us what the COSO model is for internal controls.
Sure, and that's a model that goes back to 1992 when there were a lot of financial issues out there, and it has stood the test of time. That model is still basically in place, and I guess in some respects it's kind of like, as an attorney there are various frameworks in which you operate. There are rules of civil procedure. There are rules of criminal procedure. There are certain frameworks that kind of define the rules of the road. Well, the COSO model is just the internal control version of that. It basically says that you want to use a framework that has 5 key elements. You want to have a good control environment where everybody incorporates integrity and ethical values and competence and all those things. You want to have a risk assessment that deals with the risk facing the company. You want to have good control activities that are responsive to the risk. You want to have an information system to communicate information and make sure people maintain accountability, and you want to monitor to be sure the whole thing works. Well, that's the fundamental model, and what's happened in 2013, the commission did an upgrade of the concept, which didn't change the model in terms of what the components of a good controlled system are, but they specifically added an objective for compliance, that adherence to laws and regulations to which the entity is subject is a specifically identified element of the framework. So according to that guidance material, the system of internal controls can only be considered effective if it provides reasonable assurance the organization, among other things, complies with applicable laws, rules, regulations, and external standards. So now what you have out there on the table is a well-defined, well-accepted model that defines an entity's controls, and you have specific recognition of the fact that compliance with laws is a subset of that model. So if a company sets out to defend its controls and it hasn't followed a framework and it hasn't specifically addressed compliance with laws and regulations, it may be a tough sell.
Henry, we're near the end of our time. I think we're going to have to extend our opening conversation into parts 1 and 2.
Okay.
So perhaps if I could end with this question. I believe as part of your professional life in the corporate world, you actually helped institute a COSO framework of internal controls at Transco here in Houston. If I've said that correctly, could you talk about the experience of implementing this type of framework inside of a major corporation?
Yeah, that's correct. In 1992, when this framework came out, I was vice president of internal audit at Transco, and we as a management group decided that we wanted to use that model to measure Transco's internal controls entity-wide. It was obviously, at that point in time, a fairly difficult process because it was brand new and there wasn't much understanding of it even among financial people because it was so new. But eventually, once we explained it as a framework that shows in a easily defendable manner that we have addressed the internal control issues, it became an easier sell. I think the most difficult problem, and I certainly recognize this is true with practically, if not all of the listeners, within a corporate environment, there are never enough resources of an administrative sort. And so the issue always becomes, okay, yeah, all this stuff is great, and we recognize that we need it, but where are we going to find the time? That was the biggest issue in implementing this at Transco in those days. And what it finally came down to, and it wasn't easy, but it finally came down to you have to decide what your real risks are and how do you want to allocate your limited resources, and you have to make decisions. And that kind of drives how much you can layer within the COSO framework or even outside the COSO framework. You would generally have to take away some activities in order to add the ones that address these risks. That's just the practical reality.
Henry, we're I think moved along a little more detailed than I thought. So with that, we'll end part one. Part two, we're going to pick back up right where we left off and go back into the COSO framework, and then have some other topics that I'd like to explore with you. So I'd like to thank you very much for your time. Henry, if someone wanted to get in touch with you to follow up or ask any questions about some of the thoughts you presented, is there an email they could communicate?
Certainly. They could contact me at hmixon, that's Mixon, at mixon-consulting.com.
All right. Once again, this is Tom Fox, and thank you for listening to this episode of the FCPA Compliance and Ethics Report. Thank you.